going to go through this problem. You can see I've got the answers up here, so we're going to go through how to get those answers. And it is actually taken from a problem in your book. I believe it is problem 9-2B, but you don't have to know that. You can just either print out the problem by taking a screenshot of this video or write it down. So we have Waylander Coating Companies purchased waterproofing equipment on January 6th. That's important to pay attention to what day it is purchased at, because January 6th means I'm going to take a whole year the first year. So I'll talk about if it's not January 6th in just a second. Okay, the equipment was expected to have a life of 4 years or 20,000 operating hours and a residual value of 35,000. It was used for 7,200 the first year, 64, 44, and 2,000 in year 4. So we want to determine depreciation straight line, units of activity, and double declining balance method. So under straight line, the formula is cost minus salvage value divided by life will give you the depreciation per year. In this particular case, our cost is $320,000. The salvage value is $35,000. So if you can see, I need to depreciate $285,000 worth of the equipment. And that's the cost I need to write off. I divide it by my life of 4 years, and I get $71,250 per year. I've added a couple things, but anyway, in the first year, I'll take $71,250. So my journal entry is debit depreciation expense, credit accumulated depreciation for $71,250. So my accumulated depreciation is everything that's accumulated. So in year 1, the only thing I've accumulated is the $71,250. And my book value is the cost. Don't get the cost minus salvage value, because when I bought this piece of equipment, I debited equipment for $320,000. I don't do anything with the salvage value. You'll see where that pops up in just the end. So I take my cost minus my accumulated depreciation. And so my book value at the end of 1 year is $248,750. I take $71,250 depreciation the next year. So my accumulated is everything that's prior to that. My book value is my cost minus my accumulated. And so you can see in year 2, I make the exact same entry, but depreciation expense is on the income statement. So it gets wiped out to 0 each year. So it's $71,250 each year on the financial statements, but accumulated depreciation is a contra asset, so it continues to accumulate. So it gets a $71,250 in the first year, I add another $71,250, I add another $71,250. So in year 3, I take $71,250, my accumulated is all 3, and my book value is cost minus accumulated. 106. So in year 4, I take another $71,250. My accumulated is all 4 of those. And then my book value is cost minus my accumulated. So notice that in the last year, my accumulated depreciation is $35,000, which is equal to the salvage value. So when I sell the piece of equipment, that becomes important. Now, one other thing that I kind of want to do is what happens if I only buy the asset, let's say September. So if I buy the asset in September, I would have my $71,000. I'm going to put a row in here. So in the first year, if I bought it in September, I would have that, but I would only have September, October, November, December, 4/12 of the depreciation. So I've got $23,750. In my next year, I would have it all year, so $71,250, $71,250, and $71,250. My accumulated depreciation is $23,750, $95,000, $166. And notice though, if it has a life of 4 years, it doesn't necessarily have to run a calendar year. So in the last year, I'm going to have the $71,250 times, since I had 4 months in the first year, I'll have 8/12 in the last year. And so then I'll have my 285,000, and notice that my book value at the end is still 35,000. It's just taken us 5 calendar years to get 4 years, simply because the first one had 4 months in it, and the last one had 8 months in it. So again, your depreciation expense for the first year would be just the 21,750, and then the next year my journal entry would be 71,250, the next year 71,250, the next year 71,250, and the last year would be 47,500. Depreciation expense is simply that amount on the income statement each year, but accumulated depreciation keeps accumulating. So now I'm going to go into units of activity. Okay, so the units of activity method, or units of production method, basically it's the same formula, except it's cost minus salvage value divided by the life, but the life is in units and not in years. And so now I'll have depreciation per unit instead of depreciation per year. So notice this problem says it takes 20,000 operating hours over its life, so cost minus residual value is 285,000. A life of 20,000 operating hours will give us $14.25 per hour. So in the first year, I operate it for 7,200, year 2, 6,400, year 3, 4,400, year 4, 2,000. So in the first year, I have my depreciation expense is $14.25 times the 7,200. In the next year, it's the $14.25 times the 6,400. And in the next year, it's $14.25 times the 4,400. And then the last year, it's the $14.25 times the 2,000. And notice in the last year, I'll probably just take the rest to get my book value down to 35,000. So let's just see if that works. So my accumulated depreciation is 102. So my book value is cost minus accumulated. So 214,700, 217,400, I'm sorry. So notice my journal entry in year 1 is going to be the amount of depreciation expense. So I have 102,000. In year 2, it'll be 91,2, and this 2 numbers. The next year, 62,700. So my accumulated, oops, wrong formula. My accumulated is just simply everything accumulated, and my book value is cost minus my accumulated depreciation. Year 3, my cost minus accumulated depreciation. And in year 4, it's hopefully this ends up to be 35,000, but I have and it does. And if for some reason they had said it's 2,500 in year 4, I would simply only take the 2,000 hours because I only want the book value to be down to the residual value in the last year. So that's units of activity. So you can see 102.6, 91.2, 62.7, 28.5, and my accumulated depreciation is 285,000 at the end. Now we'll go to double declining balance. In double declining balance, the first thing that you need to do is figure out the rate. So the first thing that I'm going to do is take 1 divided by the life, and my life was 4 years. So you can see that under straight line, that means 25% a year. But under double declining balance, I multiply that by 2, and so then I get 50%. So I should have put a plus there. So I have 50%, so I'll change that to a percent. So that's my rate, 1 divided by the life times 2. So what I do is I take my book value, so I'm in year 1, and so my book value is simply the cost of it, 320,000, because I don't have any depreciation yet. So book value is cost minus accumulated. My rate is 50%, so my depreciation is the book value times the rate So in year one, it's 160,000. Okay, then in year two, I get my book value, which is cost minus accumulated depreciation. So now my new book value is 160,000. My rate is 50%. So I take my cost times my rate and I get 80,000. So that's where that comes in. In year three, I take my book value, which is you can either do the 320 minus the 160 minus the 80, or the 160. I've already subtracted 320 minus 160, so I can just subtract that. So 50% is my rate, so I have that. Okay, so the last year can sometimes be complicated a little bit, not too bad, but let me see if it actually works out. So I have my new book value. Again, my book value keeps going down, 50%. So notice that I have 20,000 in the last year. Okay, and notice up here they have 5,000. But I want to show you something in my accumulated depreciation. Let me get my formula here. My accumulated depreciation is 160, then it's 80 plus 160, then it's 400. Okay, and then my book value is simply the cost minus my accumulated depreciation, and then cost minus my accumulated. Okay, but I do know that in the last year, I want two things. I want my book value to be the 35,000, and I want my accumulated to be the 285,000, which is 320 minus my salvage value. So I want this number right here to be 35,000. So since I want this number to be 35,000, my whole entire accumulated depreciation needs to be 285. So in the last year is basically a plug year. So I'm going to have that plus that plus that plus that is 285. So I need 5,000 in there to get the 285. The reason it's a plug figure is you keep taking 50% of a smaller and smaller and smaller number. You'll never get to zero. So the last year you just get it down to the balance. So my book value is always salvage value at the end. There you go.